All right, everybody, welcome back to this video on Introduction to the Bradley Barometer, Part 5. We're going to continue looking forward here into the future, and we're going to move up here into the 90s. We just got past the 1987 crash, and I'm trying to give you some examples of the Bradley in non-market crash situations and then also with some intense market crashes. So during this period, we had the rise of the market here into the dot-com bubble, and then obviously that burst into 2002, 2003, and then we had the Great Recession in this 2007, 2008, 2009 period. So we're going to look at that also. And so I'm going to try to see if we can get some common themes here of the Bradley showing up during emotional times and being able to accurately forecast during those times. So it's not just about can the Bradley forecast during normal market times, but also when things are going crazy, when people are losing their mind and selling and panic is setting in. So we're starting out here with the 1990 here. So this is, again, this is down here as the chart. This is 1990. This is 1991. There was a pretty big, pretty steep sell-off here. I wouldn't call this a severe crash, but it was a panic for sure. The Bradley did show this rising continuously. It does not show the exact peak in this case. It did not match it. It was a little bit late. The actual peak of the market here occurs here in early, looks like it's early July into here. And so the Bradley eventually does turn here, and the market was well underway here in terms of the sell-off at that point. So, I mean, at this point, you can see that the market was already well underway here. I would say two-thirds of this decline was already over. So in this case, the Bradley was a little bit late, and then it showed a low and then kind of a recovery here. That part of the Bradley turned out to be true. So you can see here that after we had this late turn here in the market, there was a little bit more of a decline here. And then the Bradley starts to make a bottom into here. And then there was a little bit of a recovery. But this we wouldn't say that this was one of the best matching cases of the Bradley, obviously. But the general form is there in terms of the general movements of the market. It was just off a little bit. And that can be a little bit unnerving for investors. This is a problem with cycle analysis too. I get into this that some of these, if you're looking at these really big cycles, and you're talking about orbs of influence, you could be off by weeks or months even, right? And so in this case, if you lost two-thirds of the rally already, clearly that wasn't an ideal situation. But nonetheless, it still more or less modeled the flow of the markets. I think when we get these really crisp lows and highs is when the markets are very emotional, which we'll get into in a little bit. This was 1995. You can see here that the Dow Jones was on this pretty steady rise here through time from 95 all the way through this 96 period into here. Really very kind of linear, low volatility type of a rise. The Bradley did have a zigzag formation into here. It does pick this initial rally here up, and then it makes a high here. It predicts a decline from here to here. You can see, and then it goes long again into here. And this is where we get into the concept of bias, or we get into the concept of, in this case, we would call this a divergence. So we have to be able to look at the trend and understand what is happening. And then we look at cycles or oscillators in the context of that. The context of this is a pretty sustained rally here. So in this case, we had a linear look on the market. It wasn't like it was making some kind of a big rounding top or something. So in this particular case, we're talking about from here to here. This was a lost portion into here, where it did still advance, but once the Bradley hits the low here in this late November December period, that's when you would expect in this uptrend to continue to accelerate here, and it does. It makes a very sharp acceleration here. This is one of the sharpest accelerations of the actual move, and that occurs while the Bradley is in this uptrend here. So again, kind of following along with this, again, this is not a crash situation, but we look at in a situation where it's not a crash, we want to look for the divergence in this case. In this case, it was a positive divergence. So we would be looking more for lows to buy on a situation like that. Okay, so crashes are very rare. And so most of the time we're having to deal with these concepts of divergence and understanding what is the underlying trend of the market and then trying to trade with that. Now it gets a little trickier, of course, at tops, but that's if you have a linear look of a market like that. I mean, there was nothing there that really looked like it was some type of a major run up or turn. Um, Here's another one here. This is 1997. So this is going a little bit further. So this one again here. So you're in this uptrend here. So the Bradley is just kind of going sideways here, not doing too much, just kind of doing this sideways turn. And then it has this big dive into here. You can see here it's looping lower, makes this double low into here. So essentially from here to here, the Bradley in this particular case does miss a good portion of this rally into here. This is the portion of the Bradley into here that was showing a decline while the market was rising. But it does continue to show the rise on either side of this too. So you can see from here to here, the market was rising into here. And then on this portion, when you get into these lows into here, you can see that the market starts to move again to the upside. And the Bradley actually, oddly enough, does still pick up some of these contours. If you look at some of these contours into here, like right into here, you can see that this little hump into here is corresponding to this one here. Even into here, this little rise into here is corresponding to this little rise into here. Even on this initial decline, you can see that this does kind of try to draw this up into here. There was an initial decline low into here, but again, the market diverged against it there. So those were just some examples of the Bradley in everyday life when we're not seeing a market crash. But let's ask ourselves the question again: what happens when the Bradley is in a crash? When the market's in a crash formation and the Bradley comes in to the picture? So the first one we're going to look at here is going to be 2002, 2003. So right here we start to see kind of like a sharpening or a focus again around a crash. So this is the 2002, 2003 low. So this is a kind of a crash formation, and it gets more impressive here because the Bradley does get more focused again. So that's the interesting thing. When the emotion is high, it seems like the Bradley gets much more focused. So you can see here the high does occur here in March. These are the March highs into here. The Bradley makes a high a little bit later here into April. But you can see the Bradley has this pretty persistent decline into here, and doesn't relent until it gets into this March 2003 period. So this was a pretty intense year of declines on the market, and the market follows this very nicely for the most part. It was started off a little bit here, but you can see the Bradley does forecast this, I think, very, very well into here. You can see this initial dip into here, and then this valley into here again is, you can see the shape here coming in to the Bradley, and then this peak into here, you can see this peak coming in here on the market right there, and then the final drawdown. And these were almost exactly matching here in terms of the lows, in terms of the March and the March. So I think the takeaway from this is that once we get into an environment that is hyper charged in terms of emotion with the market, I think the Bradley really starts to pick this up. And since that, probably because people are they're just running on the raw emotion of fear or greed at this point. So at this point, fear, and that comes out, and the transits will tend to play out at that point. So again, you can see here the low coming in this March of 2003, and then the Bradley continues to rise into here, and the market, that's the low. So in this particular case, we went back and we looked at the 1929 crash, we looked at the 1987 crash, and now we're looking at this 2002 to 2003 low. Although this wasn't a one-day crash, this was definitely a period of fear in the markets. This was after the dot-com. We weren't sure what was going to happen, and the Bradley really starts to show its power in a situation like this. So that's the 2002, 2003. So the last one I'm going to show you here is the actual Great Recession. So this is going to be the 2007 to 2008, 2009 period. In my opinion, this was the last time that the Bradley was purely run without the Fed. The Fed really gets strong into this 2009 period into here. And so this is the period right into here. Let me just circle this for you. This is where this actual data ends here on the Dow Jones. But this was the actual low. The actual lows came into March. But you can see here, this is where they started the QE. And this actually, for those of you who aren't aware, they started a process here in the fall called QE0, where they actually, I call this QE0, where they started testing quantitative easing, and they realized the market stopped going down. when they did this. And so this is when they came in with QE1 right into here, into this March period. So this was really the cementing of the market in terms of the Fed. And this is really, in my opinion, kind of the end of the Bradley in terms of being a reliable indicator for market declines. Now, it's not to say that the Bradley still can't work in some situations when the Fed is weak. The Bradley can still work. Or in theory, if you had a situation where the fear factor was so high, so intense, if there was such an, like COVID or something like that, then it could pierce through the Fed. But for the most part now, we are really under this dominant influence of the Fed from this point forward. So this is really the end of the innocence in terms of the markets running on their own at this point. So I'm just going to point that out. We're going to get into some more videos about actually how, when does it stop working, and can we actually track this? And the answer is yes, we can. We can just follow what the Fed is doing, and then we can figure out if the Bradley is going to be successful or not during those periods. But again, once we get into this type of hyper intense market activity ruled by fear and doubt, it seems like this really starts to pick up. So you can see here that in 2007, Bradley's rising into here. And again, you're starting to see these peaks are starting to take form here in the market. It's pretty amazing here. You can see the peaks are taking form here, even this valley into here. This one was a little bit late into here, but this is still rising into here. And then this rises all the way here into about this June period. Okay, now the markets were already on a decline. So again, when we talk about the concept of bias, we have to understand what is the behavior of the market at this time. So bias, and then we would also say divergence. So the question is, what is going on here at this point? So the Bradley's making a high, but what's happening? This is also called a bearish non-confirmation, when the market is starting to diverge lower like this against it. So we have these going in two different directions, and so that's a clue that we're about to get a much bigger sell-off. So I always tell people, one of the things that you got to look out for in market crashes is the following. Sometimes these will start to unfold even during a positive period. The last of the positive period, the market will start to crumble. And so again, this is a negative divergence, but we got to look for these very closely. These are important keys, because what happens when you have divergences like this, when you start to see situations where the market is moving against us, let's say that the quad lunar cycle is in a buy and the market's selling off into that, and it stays selling off, then that's a really dangerous sign for when it changes into the sell signal. So in this particular case, you have this negative bias here, definitely, and you have a negative divergence here. So the market's moving against what the Bradley is doing. And in theory, again, once this turns, if you have a negative bias on the market, once this turns, okay, you should start to see the market have a very steep response to it, to the downside, because it was already going down when it was positive, right? So now that it's turning, you should start to see a very steep decline like this, which is what we get. So we get the Bradley going into this sell-off into here, and you can see that this is one of the sharpest dips into here, okay, one of the sharpest dips. And then we get this period here where we have a little bit of a bounce. The Bradley is still falling into this particular case. We have a little bit of a bounce into here, and this is where we really get into all the heavy, the AIG and the Lehman, all this stuff's happening into here. And of course, here is our famous month again here, October, which was really the boogeyman month for a long time. That has since shifted, just so you know, since 2009. That's not the boogeyman month anymore, but it was the boogeyman from 1929 all the way to 2009. So 80 years, that's a long time to be the boogeyman. October was the boogeyman. So you can see here, here's your next drop here. This is the big drop into here. And then again, this is when the Fed comes in starting their QE zeros. So you can see the market's kind of going here, making another leg into here. The Bradley actually makes a low a few months ahead of time in this particular case. So the Bradley makes this low in December into here, so you can see this. So this is well ahead of the March into this particular case. I don't have the March into here, but this markets did bottom on March. Some of the strong stocks, you might look at some of the strong tech stocks like Google and Apple. A lot of these actually did bottom earlier and made a higher low, but the actual S&P didn't make the low until March. And then, you know, we were, the Bradley's, of course, focusing this to the upside, but now we have the Fed into here, And so it's really the end of, like I would say, the end of the innocence in terms of markets functioning on their own. And now we're into the kind of like this Darth Vader, half machine, half man situation, where these natural forces are really diminished strongly, particularly when the Fed is strong. So that's the summary here. So again, I think the takeaway here is that the Bradley does an excellent job excellent job of tracking the natural forces of the market, and particularly when we have big type of fear events, the Bradley can be very useful because it seems like that fear kind of pierces through everything. But once we get to the Fed, this is a totally different story. And we did see that during non-fear events, that the general motion of the markets was with the Bradley. It could be off by a few weeks or so, or months or so, but the general motion was generally there. Before the Fed comes in to the picture here. But the interesting thing, I think the takeaway from this is just that you have this very, very strong focus of the markets to the Bradley, sometimes turning to the day, like we saw in that 2003 example. We really have a very, very powerful tool in these types of situations because the psychology of the crowd is going to align with those transits, what's going on up in the sky. All right, guys, thanks so much for watching. I hope you enjoyed this video. Have a great evening. Stay safe out there, and I will talk to you soon. Peace out.